going to start off the show with a conversation about what I saw happening in the stock market. This is part of the educational component about asset management and kind of what to do, talking about how we manage the assets too. So I'll share my screen here so we can see this. Here's the S&P 500. Way back at the beginning there is the top, right? So the 4th of January last year, all-time high, S&P 500. Market's coming down. We can see that red line. It kept coming up and hitting that and hitting it over and over again. The blue line that's just above my head here is actually a 50% retracement line. So it just shows from the bottom of the pandemic, 2020, to the top last year, we've kind of came all the way back and gave back half of that gain just for one day. You can see that little spike there. That was October 13th. And so since October 13th, we've been moving upwards. Now, it's not a straight line, right? We're kind of still above where we are. We finally broke through the red trend line there, set up a new high. Unfortunately, we're starting to have some difficulties here, and we'll talk about why. But you can see at least intraday here, we've kind of come back through that red line. Now, that's not wildly unusual, actually. If it gets below it a lot or stays below it for a certain number of days, then we start to worry about it a bit more. But having it kind of drop through there are some things that are moving the market to the downside. We'll talk about those that are, somewhat concerning. And so we've made some changes to the portfolio today. We have kind of a green light, red light, yellow light system. We were in the green light based on the bounce off of the 200-day moving average last week. We made those changes. And then we went straight from that to a red light today. So red light means that for our retirement accounts on the stock market side, we have moved those pieces into T-bill. Normally, we don't see these many moves happening. We don't get this defensive. But we're in this situation where we're still technically in an overall downward market. And so you have to be really careful that we don't end up with sort of kind of the floor falling out from below us. We were kind of bouncing around in 2008 and sort of hanging in there, and then all of a sudden we had a 30% drop. So that's what you have to be aware of. I'd rather be in T-bills right at this point, heading into some of the things that are going to be happening over the next couple of weeks, but we'll see what happens. So let's talk about kind of what happened this week. And here's a chart of the 5 minutes, every 5 minutes for the day. And so you can see we've been basically going down all week, right? But more so kind of there at the end here, the second half. So that's yesterday and today. You can see that red line there is actually the trend line. So you can see when we broke through that today. Now, a lot of different things happened that were kind of catalysts to this because the market was doing very well at the end of last week, really well, actually. And but on Tuesday, Chairman Powell met with the Senate Banking Committee, testified there, and had some very aggressive things to say, seemed to leave the door open for the 0.5 point rate increase. He had always been the one that was kind of more reasonable, didn't seem like it on Tuesday. And so the market, you can see that big little drop there at the beginning of the week. That was Tuesday during his testimony. And really never recovered from that because what he said was that, hey, we're seeing, especially in January, a pretty hot economy. We need to bring that down. Job market is very tight. Lots of jobs created. Retail sales were high, et cetera, et cetera. And so we need to bring that down. He also testified in front of the House on Wednesday. Actually, if you look at Wednesday there in the middle, not as much motion.
Pretty much flat.
Yeah, it really was. Then he was done. The market was relieved. We saw this kind of jump up that we see there. Unfortunately, and that was Thursday, yesterday, one of the regional banks had trouble, had liquidity issues, losses on bonds and those types of things. And the market sold off pretty hard for the second half of yesterday. And you can see that right above my head here. And the reason that is a concern is just simply because of really what happens in terms of 2008. There was one thing after another started to kind of fall, and then eventually we ended up with this big downturn. And so it's bringing back those fears. Even though overall the banking system's quite healthy, it still makes you worry about what's going on.
Yeah, and you can see the drop was it spread to other regional banks, even though they may not have these similar issues because they're separate businesses. They still got hit by having this fear.
Yeah, there's just overall there's a fear in this type of situation within the big market participants that when you raise interest rates this much, you risk having something break. Okay, so Lehman Brothers was the last straw that kind of broke that market, but we had Bear Stearns back in 2008, quite a few things that were breaking. So is this, isolated in terms of this situation, or are there other kind of scenarios out there that are happening that people would be worried about? Kind of like that rot underneath the floorboards that you can't really see until it but it's there. And so that's what people are worried about. Is the direction going in this nice recovery where the pent up demand is going to push things forward, or are we kind of going the opposite direction? And just to switch back, I'll give you kind of an analogy here that's kind of interesting. If you go back to May all the way through now, we've basically been going sideways with a big range, 4,300 on the top and 3,500 on the bottom. That's a big range, but we've been in that range since May. I mean, we're getting close to a year of being in that range. This is very similar to what happened the last time inflation was fairly high. And so, we're right in the middle of that range right now. So you got to be a little bit careful of overreacting to what's going on. However, if you just sit there right now, you've basically made nothing, and there's some potential to make some money within that range, in my opinion, because it's a big enough range. And so I think this is a different type of trading methodology here. And the reason we're in that range is because the analogy I would have is like a teeter-totter, and you got a group of kids that are waiting in line to get on this teeter-totter. And right now, the two kids that are on that teeter-totter are relatively balanced. They're the same size, maybe the same age or whatever. And one kid on that side believes, hey, things are getting better. The pent-up demand is going to push, retail sales, and people are going to spend money, and that's going to help the economy. The job market is picking up. Lots of new jobs, 500,000 jobs, that came through, and then another 311,000 jobs this week. So that's that one group, and they're the ones that are buying, and they're buying these dips, and they're coming through. And they're also buying, if you look at the run-ups, they're buying like things that might do well in the future.
Yeah.
Yeah, so they're okay. They'll say, hey, I'm going to hold on to this for 5 years, and, in 5 years this could be worth a lot of money, and I want to buy it now because it's cheap or cheaper. Then there's the other side, the other kid that's on that teeter-totter who is essentially, worried about what's going to happen with inflation and what the Federal Reserve is going to do. Because the Federal Reserve has to raise rates to bring inflation down, but there's a big lag for when that hits the economy. So they really have a very difficult job. If I raise rates as the Federal Reserve a half a point or a quarter point, in a couple of weeks here, I'm not going to see the impact of that for 3 to 18 months, depending on who you talk to and depending on what it is. And so that's why it's so easy to overraise rates, because they constantly do this actually historically. So they see these data points and they see, okay, job reports and whatever it is they're looking at, and they raise rates, and all of a sudden something breaks, and then you get this other scenario. And that's the other kid on that teeter-totter. Yep. And so as the kids change out, we get these up and downs. Sometimes the kid who's optimistic is bigger, and he's kind of driving things up, et cetera. So, what we're worried about here altogether is just kind of really breaking out of that range. So that's what we'll watch for. And many of the articles out there are talking about establishing a new low for this year, right? That's all over the place. And again, once a lot of people start saying something, it's even less likely to happen, but not impossible.
Yeah, and with this regional bank knowledge or kind of run, you
Right.
could say, it kind of most of us glossed over the jobs report that came out, and
Yeah.
the jobs report came out a little bit higher, but it was kind of a mixed bag overall.
Yeah, it was 311,000 jobs, supposed to be 225,000 jobs.
Yep.
The article I read today said that they've exceeded expectations on the jobs report that comes out once a month here, 11 months in a row. So I'm thinking the expectations are a little bit low for what's been happening here. But still, it's kind of interesting because it's still less than last month. Last month was readjusted back down to 504,000, so that's actually a good thing.
Yep.
Unemployment actually went up, right? Again, ironically, in this environment, unemployment going up is a good thing because a softer job market has the potential to lower inflation faster than a tight job market. So that was a good thing. And then the other big thing that's, again, a good thing as far as the stock market is concerned in this environment is that the pace of growth of wages, it was
Just
better
coming
than
down.
expected. Yeah, it's still, wages are still going up. They're just not going up as fast. And so, that's been coming down. So theoretically, when you look at what happened in the jobs report, I think it's the same as last month because the same thing happened. Lots of jobs, wage growth was less. So it's 2 months in a row that we've had that. That's a perfect scenario. We need lots of people out there to get into these service businesses because that's where the tight inflation is, and the supply is short in the service businesses mainly because we don't have enough people working there.
Yeah,
Right.
and having like a slowing down of wages shows that the market is kind of loosening a bit.
Yeah.
There's been also a decline in postings too.
Right.
And also in the last 2 months, there's been an unusual spike in government hiring. So
Yeah.
they've hired 164,000 jobs in the
Yeah.
last 2 months. And it's unlikely that that will continue for the foreseeable future.
Yeah, could be a beginning of the year bump. Something that's happening there as far as that goes. Yeah, so it's kind of interesting if you look at the bond market, and I'll show you that here. Here's the 2-year Treasury yield. Notice that it came down predominantly on this report today from the jobs.
Yeah.
So if the yield comes down, that means the bond is going up. Okay, the bond market liked that report. Now, the stock market didn't like that report. The bond market liked it. Now, in my opinion, the bond market is kind of leading the way here as far as understanding what's happening with the numbers as they apply to inflation, because that's kind of what the bond market looks at the most. And so I think that's very fascinating. We'll see what happens if that yield, because that went from over 5% down to 4.6. That's actually a fairly big drop. And so, we'll see how that plays out. It could be that there's just a run into treasuries, right? And so lots of money's going to treasury when it got to 5. So it could just be a pure supply and demand and not so much a reaction to that report that came out, today, and or even the report about the bank that had trouble. So that's something to watch, though. We'll see that. But it's very fascinating to see the bond market do this well and have yields come down this much in this short of a period of time. So very interesting week, really interesting time frame. The market is moving very aggressively. We've been moving fairly aggressively to kind of match that. We're not moving yet our taxable accounts. We've had those in place. We have a much slower signal that we use. We have a whole basket of signals that feed into this kind of process for us. And we'll make quicker moves inside of retirement accounts, Roth IRAs and IRAs and those types of things, because there's no taxes. And we make much slower moves on the taxable side because there can be taxes, or even just putting it on your tax return and dealing with it. So, but we're very close to triggering those also on the taxable side right now. We'll see how this plays out. But if we continue down a bit more here next week, we'll be making some changes there too. So, yeah, very interesting time frame.